Hello, everyone. Welcome to another Fratarcangeli Friday market update. It's been a couple weeks since we met. We're on the heels of retail earnings, and we're looking for earnings next week for some of the more polarizing tech companies like NVIDIA, but a little bit about this week's earnings. We started the week out with Palo Alto's earnings that came in fairly hot, beating earnings per share by approximately 8% on the top line and roughly a point and a half on the bottom line. Stock has been fairly volatile this year post the merger with CyberArk, which was their biggest merger in history, as well as the fact that the stock's been down at an average of 3% year to date. So we're really watching future guidance, which is looking to be fairly strong. And the fact that they beat earnings pretty strongly, we feel that that company is poised for more upside. We also had retail sales with Target and Walmart, Walmart being the more watched report, and Walmart beat earnings by approximately 1 cent, but the stock was down close to 5% right off the bat, and we're watching very closely to see how that retail sector performs here through earnings, but that is something we're watching and will continue to watch. We also had Home Depot report on Tuesday, and we had some mixed numbers. Revenues were up year over year by approximately 5%, and we saw that shoppers spent more per trip than they had the previous year. So some good outlook there, but only up 1.5% year to date versus the S&P 500 that's closer to 10%. So certainly something we're watching and keeping a close eye on as it relates to retail sales. Now, we're also going to be looking at next week where NVIDIA will be reporting earnings. We all have been watching NVIDIA and some of their parent companies and how they've done throughout the earnings season. We expect some very strong things next week with that report. Moving on to economic data, we had Jerome Powell decide to leave rates alone, and we recently revisited the minutes and all the details relative to the Fed meeting last week, and it's been over 30 years since we had what we call a dissent. So 2 of the Fed chairs have gone against Jerome Powell's guidance of leaving rates alone. That's something that, as I mentioned, we have not seen in 3 decades. And some of the rationale for Jerome Powell leaving rates alone was the fact that they're really watching labor numbers very closely. Unemployment numbers, specifically, we're showing some signs of potential slowing in the unemployment numbers, which gives some concern. We're also looking at housing starts that jumped roughly 5.2%. The most in 5 months, and that's a sign of inflation, as well as existing home sales in the United States growing by 2% from the previous month for a seasonality adjustment that's annualizing at approximately 4 million in July of 2025. So we're seeing some movement relative to existing home sales, and we also are seeing housing starts jump, which creates some question as to whether there's some inflationary pressure and getting down to the target numbers that we know that the Fed has talked about now since 2022. Now, I know that the Jerome Powell Fed chair will be speaking this morning at 10 a.m., so we'll be watching very closely to some of his comments. Currently, the market is telling us they're expecting about a 95% chance that rates will be lowered in September. And I think that's very important to a number of points of sales, including car dealerships and a number of revolving credit lines that have been affected by these, call it short-term rates, staying lofty and causing a higher cost of carry. And I think causing companies to really watch their inventories and make a more conservative approach to building up their inventories. If rates were to come down, I think you could have a nice response. It could also affect mortgage rates. It could also affect the fact that we're starting to see more inventory in housing. So I think this is one of the major areas that we're going to be watching extremely close over the coming weeks and certainly in September, as we know the markets are typically more volatile. You know, you wonder, why does August, September, and October tend to be the more volatile, negative performing months? And we question that. Many say that it's due to volume. Volume's a little bit lower as many of us are on vacation and taking that last summer trip before the kids go back to school. But there's also a lull in economic data. So there's a multitude of reasons why typically we're seeing August, September, as well as going into October, some of the slower market performing months. So we're wondering if that's going to be persistent here this year as we continue to see momentum in the markets leading up to August. We're also watching very closely the meetings that transpired earlier this week between Trump and many of the European leaders discussing how we can bring an end to the Russian-Ukraine war. And I know there's a number of discussions around a U.S. weapon package that would include a $90 billion spend. We're also looking at security guarantees that Zelensky has said that he is looking to put together and formally outline. U.S. and NATO military plans are evolving simultaneously. So we're seeing some momentum, but really no clarity quite yet. How much that will affect the global economy as well as the U.S. economy is something we're watching and interpreting along that path, but just seeing how we can come to an end to a war that's been going on since February of 2022 would certainly be well received by, I believe, everyone. I think the biggest focus will be next week's durable goods report that we'll be receiving, as well as the GDP growth rates quarter over quarter for second quarter estimates. That'll be something that we watch very closely as we lean in to see potential for the Fed moving rates down come February by either a quarter of a point or a half a point. I will say, amongst all these details, interest rates, earnings, retail, and of course, the well-watched NVIDIA earnings that we're waiting for, I would believe that if the market were to trade down in September like it has historically, I believe this will be a buying opportunity for our longer-term investment strategies and allowing us to dollar cost average into the proper allocation that we're targeting and look at this as an opportunity to build towards what we believe to be a long-term bull market that is still intact. As a matter of fact, I will tell you, even amongst all of this data, earnings reports on retail, as well as the interest rate and dissent that's coming from some of the governors within the, call it, Federal Reserve, I still believe very strongly, but yet cautiously, that we have an upside in this overall market in the coming years due to many factors. I think one being the deregulatory environment, as well as the fact that we have clarity on the big, beautiful bill and more so on tariffs. And let's not forget the technological expansion that we're in the midst of called AI or artificial intelligence. So I believe there's a lot to be excited about, but a number of things that we have to focus on to make sure that we're watching every little detail as it unfolds to make sure that we're not seeing any changes in the environment near term. We'll keep a very close eye on it. We're all hands on deck here at Fratarcangeli Wealth Management. I look forward to talking to you all in the coming weeks. Be well.